Hi, everyone. So we are here to discuss about the valuation of two bonds. So the understanding of bond valuation and investment strategy in a changing economy. So the first thing is I'm gonna briefly explain how does that work, the bond valuation and investment strategy. So there's a few key concepts that we're gonna follow for this presentation. So first, the bond valuation. It's understanding how bond prices are determined and how time value of money impact these prices. What's the impact of the interest rate? How changes in interest rate affect bond prices? And the objective of this presentation is answering questions about the impact of bond maturity on market prices, what change due to interest rate fluctuation and investment strategy during an economic slowdown. Okay, so the first question that I was asked was, which bond will trade at a higher price in the market and why? So we have two bonds. We have bond A, which has a 30 years maturity, and bond B, only 5 years maturity. They both have the same credit rating, par value, and coupon rate. So let's have a look. So the bond A has a longer maturity. So what does that mean? It means we're gonna have more future payment, and these payments are more sensitive to interest rate. The bond B, which has a shorter maturity, we're gonna have a less future payment, so they're gonna be less sensitive to interest rate. And that's what Ross, Westfield, and Jave are explaining in the article that I put the reference at the end. So why the bond A will trade at a higher price initially? So the longer term bond will have a higher price when the interest rate are lower due to the higher present value of their future cash flow. However, as the bond maturity increases, it becomes more sensitive to change in interest rates, which affects its price more substantially. So the next question is, what's the impact of the interest rate on bond price? So I've already briefly explained. So the question is, what happens to the market price of each bond if interest rate in the economy go up? So what's the effect of rising interest rates? So the general rule, so the bond prices and interest rate have an inverse relationship because we divide by the interest rate. So if the interest rate rise, the present value of the future cash flow will decrease. So that's the formula we saw in the class, leading to a decline in bond price. So bond A, who has a longer maturity, is more sensitive to interest rates if it's increased because it has more year with future cash flow. So the price will decrease more. And bond B is less sensitive if the interest rate change because it has less future cash flow. So we are going to discount in a shorter period of time. Okay, so let's move on to the question 4, which is the percentage price change. Okay, let me just make it more clear. So which bond would have a higher percentage price change if interest rates goes up? So the price sensitivity to interest rate change. So the bond A will experience a larger percentage change in price compared to bond B because it has a longer duration, make it more sensitive to interest rate movement. So that's exactly what I explained theoretically in the previous slide. So now I'm going to show you with a numerical example. So let's take bond A with the longer maturity. So the original price is 1,000, interest rate increase 1%. So we had 8%. 1,000 times 8%, it's $80 decrease. So the new price is going to be $980. And let's compare it to bond price B. So the original price was 1,000 and the interest rate again decreased 1%. So we're going to estimate the price drop by 3%. So 1,000 times 3%, 30% decrease. So the new price is going to be 970. So we can see in this example that the impact of a higher interest rate is lower when the maturity is shorter. So the conclusion is that bond A has a larger percentage drop because it has a longer maturity, which exposes it to a greater interest risk. And that's what is explained by Baker in the reference that I put at the end. Okay, so let's go down, let's continue. In an investment, so if the economy goes over the next 12 months in a slowdown, what would be your investment strategy? Okay, so what's the impact of the economy slowdown and the interest rates? So on the short-term bonds, if the short-term bonds, they are less sensitivity to the interest rate increase, right? So they will have experienced smaller price decline. They will have a less exposure to rate hikes. So we should also consider diversification. So a diverse bond of portfolio across different maturity will obviously help to better manage the risk, right? Because not everything will be impacted at the same time. And also during a slowdown, a high quality bond is generally safer. So if there is a slowdown in the economy, it's how the market will react to that. So if you take something, um, a, for example, a bond from a country like France or a European country that have been stable for the past 20 years, they're going to be more stable and the risk of default is lower. That's also explained in an article. So that's what I'm saying. So consider a bond from the state, US Treasury or certificate of deposit. They are safer in an uncertain economy. Okay, so that brings us to the conclusion about the different subjects that we were supposed to discuss today. So the bond A, which has a longer maturity, will be traded at a higher price, but will experience a more sensitivity to a change in the interest rate, especially if the interest rate will rise. And so if the interest rates rise, it will experience a larger price decrease. However, if we have a lower maturity like bond B, only 5 years, it will have a smaller price decrease when the interest rate rise, making it less sensitive to rates change. What should be your investment strategy in a slowing economy? You should focus on short-term bonds. Why? Because they are less sensitive to rates change, high quality bond, and diversification. That's really the three key that you should follow. And that will minimize the risk to your portfolio. So that's my reference. And thank you for listening. I hope you had a good presentation. Thank you.